There's kind of different levels of mortgage pre-approval. Certain lenders look at the pre-approval differently, and the way the actual mortgage broker or mortgage specialist is assessing your application can be drastically different. So the most important thing to do when looking at pre-approval is to ensure that your lender or bank specialist is actually underwriting all the documentation. So, looking at your actual income verification documents, checking the down payment sources, making sure that everything on your credit score and your credit bureau is strong. And that gives you the best assessment of kind of your true purchasing power. What can happen a lot of times with individuals if they just say, I make $80,000 a year, but then we find out that, $20,000 of that 80 is actually from overtime income, but they don't have a long enough time horizon to verify that additional income amount. When you end up sending it into the lender, they may reduce the income to say $60,000, and now that pre-approval that you anticipated with a $1,000 income has been reduced significantly. So the more additional documentation and kind of pre-underwriting you can do on the file, the more stronger the assessment is going to be to verify that pre-approval amount. Additionally, sometimes people may acquire additional debts or liabilities between the time they get a pre-approval and the time they're actually purchasing a property. If you go out and buy $1,000 a month truck, it's going to impact how much you can afford, and it may change, that drastically, that pre-approval amount.